Hi and welcome to another session. In this session, we will be learning the rules for debit and credit. Now, the rules covered in this session are based on the traditional approach. There are rules for debit and credit based on the modern approach. I would be covering that in the future videos. So, there are few things that you need to remember or you should know. First is accounting is based on double entry system of bookkeeping. Now, what does double entry system of bookkeeping says? It says every transaction has two aspects, a debit aspect and a credit aspect. What do you mean by debit and credit has been explained in another video. You can watch that to understand the meaning of these two terms. But in accounting, you prepare formats. And one of the format that you prepare is that of an account. So the left side of that account is referred as debit and the right side of that account is referred as credit. So double entry system of bookkeeping says for every transaction there will be a debit aspect and a credit aspect. This also brings us to the conclusion that if you total all the transactions that you have recorded in accounting, the total of debit would always be equal to the total of credit. We will have a look at the rules that are there and how do we identify what to debit and what to credit in a moment. But these are the two things that you should always remember, that accounting is based on double entry system of bookkeeping and every transaction has two aspects, a debit aspect and a credit aspect. So what would you learn in this session? Well, in this session you will learn to identify and classify accounts. That's the first thing that you would learn. And you would also learn what to debit and what to credit. So these are the key points or the main things that you would learn in this session. In accounting, all the transactions can be grouped under few broad categories. And based on the category, the rule is applied to a particular transaction. So here, what we are learning is what is the classification, and ahead we will learn what do we mean by it. So as per the traditional approach, the accounts can be classified into personal and impersonal accounts. Now personal account, as the name suggests, is account of a person. An impersonal account would include all the accounts that do not belong to a person. We will understand in detail ahead in this video what does this mean. And under impersonal there are two more categories, that is real account and nominal account. So the first thing that you have to remember is, if you need to identify what is to be debited and what is to be credited, you should know this. That is the classification of accounts. All accounts can be categorized into personal and impersonal, and impersonal can further be divided into real account and nominal account. So what do you mean by personal accounts? Well, personal accounts includes accounts of all individuals, organization, firms, companies, or any form of business that would be included in personal accounts. So let's understand this in even more detail. So under personal account, all the accounts of natural persons would be included and the rule for personal account is going to be applied to them. Now what do I mean by natural person? By natural person I mean the accounts of human beings. Now who could it be? Well, it would include accounts of all individuals. Now individuals could be a vendor or a customer. It would include the accounts of all the trade payables. What is trade payable? Trade payable is the person from whom we have bought inventory on credit. It is also known as creditor. and it will include trade receivables. Trade receivable is the person to whom we've sold inventory on credit, and it is also known as debtors. It would also include the capital and drawings account. Now, what is capital and drawings account? It is the account of owner. Whenever he invests money in the business, it is referred as capital, and when he withdraws from the business, it is known as drawings. So the owner's account is also going to come under this category, and the rule for personal account is going to be applied to them. The rule for personal account would also be applied to the accounts of artificial persons and representative accounts. Now, what does this mean? By artificial person, it means the accounts of other companies with whom our business has made a transaction, or any other form of business with whom our business has made a transaction. So, if there is a name of a company or any other firm or any kind of business in the transaction, then the rule for personal account is going to be applied. The same rule is also going to be applied to outstanding expense account and outstanding income account. Now, what do you mean by outstanding? Outstanding means that you've yet not paid for an expense, and outstanding income means that you have given a service or sold a product, but you've yet not received the money from them. So, outstanding expense and outstanding income would also come under personal account, and therefore the rule of personal account is going to be applied to these accounts. Then lastly, the rule for personal account is also going to be applied to prepaid expense account and prepaid income account. What is a prepaid expense account? Prepaid expense is that you've yet not bought something or you've yet not taken a service from someone, but you've paid in advance. And prepaid income is going to be you've yet not delivered a service or a product, but you've received the money in advance. So whenever you pay in advance or you receive in advance, in that case also the rule for personal account is going to be applied. Now, these are just examples. So what you have to remember is you have to remember that the rule for personal accounts is going to be applied to the accounts of all natural persons, all artificial persons, that includes all the businesses, and representative accounts. And representative accounts are outstanding expense account, outstanding income account, prepaid expense account, and prepaid income account. So the rule for personal account is going to apply to the accounts of all individuals, firms, companies, organizations, institution, representative account, and any other business with whom a transaction is being made. So the rule for personal account is debit the receiver and credit the giver. Now let's understand this rule with the help of an example. So whenever you are recording an entry, there are a few steps which you can follow. I have listed them down. If you want, you can make a note of them and follow them whenever you're recording an entry. So the first step is to read the transaction. The second step is to identify the two aspects or the two accounts involved in that transaction. The third step is, once you have identified the two accounts involved, you should then identify the class of each account, whether it is real, personal, or nominal. Once you have identified the class of account, then you should apply the rule and see whether you need to debit that account or credit that account. And the final step is to record the entry. So whenever you're recording the transaction, you should follow these steps. Once you have recorded 25 to 50 transactions with these steps, then you don't need to follow them. Then automatically you will be able to identify what to debit and what to credit. But initially I would suggest that you should follow these steps. Now let's take a transaction and apply the rule to it. So the transaction is May 1, Sarah opened a business bank account and introduced capital worth 100,000. So the first step is read the transaction. So we've read the transaction, but while we are reading the transaction, we also have to identify which are the two accounts involved. So the two things that are involved over here is Sarah has opened a business bank account and introduced capital worth 100,000. So Sarah has introduced money in the business, and whenever the owner introduces money in the business, it is referred as capital. And where is this capital? This capital is in the business bank account. Therefore, the two accounts involved over here are Sarah's account. Now, the owner's account is referred as capital account in the books of business. So, we won't write Sarah's account, we will write capital. And the moment we use this term, we would know that it is the owner. Who is the owner? Sarah. And she has given money to the business, or she has invested money in the business. And where did she put this money? She has deposited this money into the business bank account. So step 1 was to read the transaction, and step 2 is to identify the two accounts. So we have identified the two accounts. First account is capital and second account is bank. Now let's identify the class of accounts. So the first account over here is capital account or Sarah's account. Sarah is the owner. So it's the account of a human being or an individual. And whenever the account is of an individual, the rule of personal account is going to be applied. To capital account, therefore, we will apply the rule of personal account. And what's the rule? Debit the receiver, credit the giver. Now let's have a look at the second account. Now this is bank account. Bank is a business, and what we had seen in the previous slide, that if it is the account of a business, then to that we will apply the rule of personal account. So for this also we will be using the rule of personal account. This is an account of an individual and this is an account of an institution or a business. Therefore they belong to personal account, and the rule for personal account is going to be applied. Now let's move ahead. So we have read the transaction, identified the two accounts. What are the two accounts? Capital account and bank account. Then this is an account of an individual and this is account of an institution. Therefore, this is personal account and even the second one is personal account. Now we will see the rule that is to be applied. Now the rule says debit the receiver and credit the giver. Okay. So here let's see. Now this capital is coming in the business. So we will see everything with the point of view as to what is coming in the business or who is giving to the business. So this capital is being given to the business by Sarah. Therefore Sarah is the giver and Sarah is giving this money to whom? To the business bank account. Therefore the bank account is the receiver of this money. So Sarah is the giver and bank account is the receiver. So the rule says that debit the receiver. So we are going to debit bank account and credit the giver. So therefore we are going to credit capital account. I'll do this all over again. First we read the transaction. After reading the transaction, we identified the two accounts. The two accounts were capital and bank. Now capital is account of an individual and bank is an account of an institution. Whenever it is going to be an individual, then it comes under the category of personal account, and whenever it is going to be an account of a business or an institution, that will also come under the personal account. And the rule says debit the receiver, credit the giver. So Bank is getting the money, therefore bank account would be debited, and capital is the person who's giving the money. So capital account would be credited. Now let's have a look at the entry. So this is your fifth step. You would always write the debit entry first and the credit entry second. So this is how it is going to look like in simple terms. After analyzing, we identify that bank account needs to be debited with the value 100,000 and capital account needs to be credited with the value 100,000. This is the lesson 1 of this series. In the further lessons, I will be writing journal entries for transactions based on these rules. So the format as to how do you place this in the format would be covered in those videos. Right now we are just analyzing the transactions and trying to identify what to debit and what to credit. So in the videos wherein we are going to write the journal entries, we'll see how we place this in the format of a journal. Now let's move on to impersonal accounts. Impersonal accounts can be further classified into real account and nominal account. So let's understand real account first. So what do you mean by real account? The account of all the assets is going to come under the category real account, and the rule for real account is going to be applied to them. Now real account can also be classified as tangible real account and intangible real account. Under tangible real account, you will have all the tangible assets, and under the intangible real account, you will have all the intangible assets. Now, what are tangible assets? Tangible assets are the resources of the business which would be used to generate revenue. But the word tangible means that these resources can be seen and touched. But when we go to intangible real account, then intangible real account are the assets that they are assets, but you cannot really see them or touch them. Let's have a look at few examples. Now machinery, furniture, equipment, cash in hand, cash at bank and property. All of these are assets. But these would come under the category tangible assets. Why? Because you can see them, you can touch them. And all these would come under the category real account, and the rule for real account is going to be applied to these assets. Now let's see a few more examples. So you have premises, inventory, goods and stock, investments. These are also tangible assets. These would also come under the category of real account, and the rule for real account is going to be applied to them. Now let's see patents and goodwill. These are assets of the firm, but you cannot see them or you cannot touch them. Therefore, these are intangible assets. So these would come under the category intangible real account, and they will also come under this category, and the rule for real account is going to be applied to them. So real account rule is going to be applied to all the assets, whether they are tangible or intangible. Now that we have understood what would come under real account, let's have a look at the rule and take a transaction and apply the rule to the transaction. So the rule for real account is debit what comes in and credit what goes out. Now when I say debit what comes in, it means debit what comes in the business and credit what goes out of the business. So if there is an asset that is coming in the business, then you will debit it, and if the asset is going out of the business, you will credit it. So if the business is buying an asset, you will debit it, and if the business is selling an asset, you will credit it. And the meaning of debit and credit is already covered in another video, which you can watch after this video. Now let's take the transaction and apply the rule to it. So the transaction is on May 6th, the business purchased machinery and paid by cash $25,000. So what was the first step? The first step was to read the transaction. And then once we've read the transaction, we need to identify the two accounts involved. So the two accounts involved are, what did we purchase? Machinery. So machinery is the first account. And how did we get this machinery? We paid by cash. So cash becomes our second account. So identify the two accounts was the second step. So we've identified that one account is machinery and the second account is cash. Now these accounts belong to which class of accounts? That is what we need to identify. Machinery is an object and cash is also an object, and both of them are tangible. Therefore these are tangible real assets. And what was the rule? That if they are assets, whether they are tangible or intangible, the rule for real account is going to be applied to them. So both would come under real account, and the rule for real account needs to be applied to them. Now the next thing is, machinery is coming in the business and cash is going out of the business. We are buying machinery, the business is buying machinery, and it is paying by cash. So cash is going out of the business and machinery is coming in the business. And what was the rule? Debit what comes in. So machinery is coming in the business, so we are going to debit it, and credit what goes out of the business. So cash is going out of the business, therefore we need to credit it. So we read the transaction. We identified the two accounts. The two accounts are machinery and cash. Then we identified the class of account. Both of these are objects, and any resource that is going to be used for the purpose of generating revenue is an asset. And all assets, whether they are tangible or intangible, they will come under real account. And machinery is coming in the business, cash is going out of the business. You debit what comes in and you credit what goes out. And then the final step was to record the entry. So on May 6th, machinery came in. You always write the debit entry first. So I'm writing the debit entry at the top and the credit entry under that. So machinery debit Y value 25,000 and cash credit, and the value is 25,000. How to place them in journal and in ledger is what we would learn in future videos. So we looked at classification of accounts, and we've already covered personal account, and we were looking at impersonal account. Impersonal account can be further subdivided into real account and nominal account, and we've also covered real account. Now we are left with only nominal account. So let's understand nominal account. The third and the final classification is nominal account. Now what would come under nominal account? Well, under nominal account, we will have the accounts of all the expenses and losses and all the incomes and gains. So if there is any expense, that would come under this, and the rule for nominal account is going to be applied to it. And if there is any income, that would also come under nominal account. And while recording entry, the rule for nominal account is going to be applied to it. Now let's see few examples. So these are the examples of expenses and losses. So rent, the business pays rent for the premise in which it is functioning, then that becomes expense for the business, so that would come under this category. Salary of all the employees, that would also come under nominal account. If there are any wages that are paid, then that would also come under nominal account. If whenever the business is going to buy inventory, that is termed as purchases, and purchases is an expense for the business, therefore the rule for nominal account is going to be applied to it. Now carriage, you will come across the term carriage inward and carriage outward. Both of them would come under nominal account, and the rule for nominal account is going to be applied to it. That is interest paid and discount given to any customer. Now all of these are expenses. Over and above this also you will see a lot of other expenses. These are just few examples. So if there is any expense, that would come under this category, and the rule for nominal account is going to be applied to it. Now let's have a look at few incomes and gains, because I said both of these are going to come under the category of nominal account, and the rule for nominal account is going to be applied to it. So what would come over here, or what are the examples? Interest received. Whenever the business receives any interest, then that would come under this, and the rule for nominal account is going to be applied. Then the same thing is going to be done with discount received. When you give discount, it is an expense. When you receive discount, then that's a income for the business. Sales is an income for the business. Commission received is going to be an income for the business. Rent received is going to be an income for the business. So if it is rent paid, it's expense. If it is rent received, it's an income. And there could be many other expenses and losses and incomes and gains. All of them would come under nominal account, and the rule for nominal account is going to be applied. Now let's have a look at the rule for nominal account. It says debit all expenses and losses and credit all incomes and gains. And where can you find the meaning of these terms? That you can watch in the video, the link of which is provided in the description box. So debit all expenses and losses, credit all incomes and gains. Now let's take a transaction and apply the rule for nominal account. So on May 10th, the business paid rent $5,000 by cash. So the first step was to read the transaction. Now we need to identify the two accounts. So rent would be one account, because what is being paid? Rent. And how is this rent being paid? So this rent is being paid by cash. So step 2, identify the account. So the two accounts are rent and cash. Now the third step is to identify what type of account or what class of account are these. So what is rent? Rent is an expense for the business here. And what is cash? Cash is an object. It's a resource for the business that is being used to pay rent. So rent is an expense and cash is a resource or an object. Now expense would come under nominal account, or the rule for nominal account is going to be applied to it. And cash is an object, it's an asset, therefore it belongs to real account. So the rule for a real account is going to be applied. Over here you need to understand that it may happen that the two accounts involved in a transaction belong to different class of account or different type of account. In the previous two transactions, I had picked up transaction which belonged to the same class of account or same type of account. But that's not the case in real life. In real life, you will have transactions wherein the two accounts involved are going to be of different class or different type. So rent is an expense, therefore it will follow the rule of real account, and cash is an object, therefore it will follow the rule of real account. Now the rule for nominal account was debit all expenses and losses and credit all incomes and gains. Rent is an expense, therefore it will be debited, and the rule for real account was debit what comes in the business and credit what goes out of the business. Now we are talking about assets here. So cash is an asset, therefore it comes under the category real account, and it is going out of the business because we are paying rent. So we are paying rent and cash is going out of the business. So we are going to debit rent and credit cash. Rent is an expense and expenses belong to nominal account, and all expenses are debited. Cash is a resource or an object, therefore it will come under the category real account, and it is going out of the business, therefore it needs to be credited. Let's have a look at the entry, which is our step 5. May 10, rent will be debited. It's an expense, value 5,000, and cash would be credited. Why? Because it is going out of the business and the value is going to be 5,000. So this is how you analyze the transaction before you actually record it into journal or ledger. All of these would be covered in the future videos. Just try reading few transaction and analyzing with the way I have explained you. Now let's take another example over here wherein we'll take an income and try to record entry for it. So the next transaction is on May 12 and the transaction is interest received 1000 in bank. So we've read the transaction. Now we need to identify the two accounts involved. Now the two accounts involved here are interest received, and how are you receiving this interest, or where are you receiving this interest? It is coming in the business bank account. So the two accounts involved over here are interest received and bank. Now this is business bank account and not owner's personal account. Now they belong to which class of account or which kind of account? Interest received is an income and bank is an organization. So interest received is an income, and whenever it is an income, it will belong to the category nominal account, and all organization or businesses come under the category personal account. And we've already covered this in previous slide. In case you have any confusion, you can watch this video again. That will help you. You must watch each and every video at least 2 to 3 times, or go through each concept 2 to 3 times, because this is a new subject and you need to revisit it initially multiple number of times for it to register. So interest received is an income, and income comes under the category nominal account, and you credit all incomes. Bank is an organization. Organization, firms, individuals come under the category personal account, and bank is receiving the money. So we are going to credit interest received and debit bank. Let's do it one more time. Interest received is an income, and incomes come under the category nominal account, and the rule for nominal account is debit all expenses and losses and credit all incomes and gains. So we are going to credit this. Bank is an organization. Organization will come under the category personal account, and the rule for personal account is debit the receiver and credit the giver. Therefore bank will be debited. Now let's have a look at the entry. So the entry is on May 12. Bank will be debited with value 1000, and interest received is going to be credited and the value is going to be 1000. So that's all in this session. I would suggest you should go through these concepts 2-3 times or multiple number of times for it to register with you permanently. Now in the future videos, I'll be taking transactions and writing them in journal and ledgers. So let's summarize this session. Accounting is based on double entry system of bookkeeping. Therefore, each transaction is going to have a debit aspect and a credit aspect. Now after watching this video, we can safely conclude that the total of all the debit entries would always be equal to the total of all the credit entries. And what do you mean by debit and credit? Well, there's a format which is called account, and the left side of the account is referred as debit side, and the right side of the account is referred as credit side. So that's all in this session. In case you have any doubts, you can leave them in the comment section below. Till the next video, bye bye.